Welcome to the Skillick Explains video. This week, how to value a company. So, with no more ado, and this is the basics, the golden rule is this. At the end of the day, companies, shares, investments have to obey a very simple rule, which is that buyers always want to pay as little as possible for them, and sellers always want to get as much as possible. So the question is, when you're dealing with something like a company, or looking at shares, where do you start? How do you know if something is undervalued or overvalued? And one approach is some investors like to try and work out what I call a kind of intrinsic value, sort of what they think something's worth, before comparing it to what the market thinks it's worth. So, short video, introduction, let's take a look at 3 ways you could approach valuing something like a company with a view to taking a look at, well, does that mean it's therefore cheap or expensive or about a fair deal, let's say. Now, the basics. Let's start with a house. How do you value anything? How do you value your property? Well, arguably, there are 3 different approaches you could take, and these apply equally to a house as they do to a business, one could argue. So, the value could be based on a bottom-up assessment of what it would cost to buy the land and put the property there, the bricks and mortar and labour costs and so on. That would be a cost basis, and you could eventually come up with some sort of estimate. Or, you might simply say, actually, what I'd probably prefer to do is compare my house, or the one I'm looking at, to other houses in the street, other houses in the area, and make adjustments for the fact that the one I'm looking at isn't identical to the other ones I'm looking at, but I can factor that in. That's more of a kind of top-down comparative approach. Or you could say, actually, what ultimately is a house worth? And there is a view that says the value of any asset is ultimately only the future income that it can generate for you. So you might say, if I were to rent this property out, how much rent would it generate? If I could add up all the future rent and compare it like for like in today's money, that would give me a value for the property. It would be the income-based value for the property. And those 3 approaches are actually the approaches that we can take to valuing a company, something a little bit more complicated, but nonetheless the basic principles apply. So, we could use all of these principles to decide whether a company is fairly valued, overvalued, or undervalued. How would that work? Very quick summary. The net assets approach would require us to identify all of a firm's assets at market value. So the stuff you can kick, the tangible assets, property, plant and equipment, and all the rest of it. We'd then have to identify the liabilities at market value, and we'd have to make an assessment of all of them. So you can't just necessarily take what's on the balance sheet at this point. If you're not sure about balance sheets, do see my video, What is a Balance Sheet? Because there might be liabilities missing from the balance sheet, outstanding court cases, legal problems that we need to try and estimate the value, or estimate the cheque we might have to write. So we'd have to sit down, come up with tangible assets at market value, liabilities at their market value. That would get us to a net tangible assets figure, but is that the amount we'd actually pay for a company? No, we might be prepared to pay more, typically for what's called the goodwill, the stuff that isn't in the books, the brand name, the market share, the employees, and so on. So, if this is kind of bottom up, we could come up with a list of all of those and add them up, we'd have some kind of bottom up valuation of the company. The trickiest number, arguably, to come up with is that one, which might lead us to use another approach anyway. But as a starting point, a sort of quick and dirty, bottom up, what is the business worth is not a bad place to kick off. Now, never rely on one number. When you're negotiating something, you need a range of numbers. So how can we get another number? How can we get a number which may, by coincidence, be the same, or may be different because it uses slightly different assumptions? Well, the comparative, sort of compare it to other houses in the street approach, if I can call it that, would be to say, well, the company I'm looking at is forecast to generate annual earnings of 200 million, let's say. Very simple example here. Existing peers, so companies that are like it, and one of the problems with this approach is you've got to be comfortable they are sort of like it. So companies that are like it, that do similar things, that are a similar size and so on, trade on an average PE of 12. Is there a way, and there is, that I can apply one piece of information to the other? This very simple comparative approach might say, well, if you rearrange a PE ratio, so if the PE is 12, all right, and you've got annual earnings, you've got the E of 200 million. If you multiply both sides by E or 200 million, you would conclude that the price is 12 times that. Just crunching the maths very quickly. So 200 million times 12, or 2.4 billion, roughly speaking. Now, that is a pretty quick and dirty approach, and it's built on a whole load of assumptions. And I'll just leave you with a few thoughts here. How similar is this firm to its peers in terms of risk? Because you can't just apply a PE of 12 blanket style if the risk factors are different. Is a PE ratio the most appropriate number to use? Maybe if the business is driven by sales, we should use price to sales. Maybe if it's driven by book value increase, price to book. You get the idea. But the principle could still be applied. And how representative is the annual earnings figure that I've chosen as the whole basis of extrapolating its value? So quite a few things to think about. Didn't say any of this was easy, and there's a lot I'm leaving out, but you get the basic principle behind what we're trying to do here. But again, for a lot of people, all this does is provide a sort of quick and dirty comparison, sort of ballpark, am I in the right number area for the main method coming up, which is discounted cash flow. Now, in a short video, I'm not going to cover all of discounted cash flow. I might do that in future videos if there's demand. But in principle, what am I trying to do? I'm saying ultimately an asset is worth the current value of the future net income it can generate. So back to the house for a moment. That is in theory worth the annual rental income, net, less costs, for the remaining life of the property, however many years that is, all expressed in today's money terms. Because £1 received in 5 years' time as rental isn't worth the same as £1 now, a principle I cover in other earlier videos. So we need to come up with a way of working out future income, deducting future costs, and then, as they call it, discounting all of that back to our present value today. Now, just to give you a snapshot in this video, then I'll stop on how that might work. For a company, what you need to do is forecast future revenues. Yes, there is some of that involved. Forecast future costs. Again, some of that involved. The difference, you could say, is the company's future annual cash flows for next year, the year after that. Then you need to identify a discount rate because you need to compare like for like. So next year's cash flow is probably worth more than the cash flow you get in 5 years' time, even if they're identical amounts because of the time erosion effect, if you like, on money. So identify a discount rate, work out a net present value for each of those years' cash flows, and add them all up. All right, it is quite an art, and that's why some people have described discounted cash flow as an estimate multiplied by a guess. But at the end of the day, valuing companies is difficult and does require you to make assumptions and ask difficult questions. Just because you have to ask difficult questions doesn't mean you shouldn't do it. In summary, you end up, this is very much a top level presentation, with something that looks like this. You forecast cash in over the years you think you can do it accurately for, maybe the next 5, and then after that you make an assumption. All right, in technical terms, you start to look at a terminal value, as they call it. Then you look at cash outflows, forecast those out for, say, the next 5 years, if that's the period over which you think you can do it on an annual basis, and then sort of have a recurring assumed number for the years after that. That gives you a net cash flow, one minus the other, for each of the next, say, 5 years and the period thereafter, because we're not expecting the company to go bust after just 5 years. Discount all of those back, applying what's called a discount factor, which basically tries to make sure that all of these amounts are expressed in today's money. Add them all up, easy for me to say, and you get what's called the net present value of the company's future cash flows. And now you're getting close to saying, well, that is intrinsically what I think this company is worth, okay? What does the market think it's worth, if you want to see it that way? So, you know, what's the current value according to the market and how far out are we? Or if it was a company that's never been into the market, never been valued publicly before, that would be the basis for negotiating the price, okay? And obviously the assumptions that you make about future cash flows, about the discount rate that you use will affect the number that drops out at the bottom. But at the end of the day, valuing trading companies is a process of negotiation. Covered a lot of ground in a short space of time there. If you'd like to know a bit more, or you'd like me to take that video a bit further, editor@killick.com.